While U.S. markets flirt with bubble anxiety, the Baltic stock market keeps tripping on its own shoelaces. Not a single IPO out of Latvia this year, only Energia in Lithuania and Primostar Group in Estonia, both on First North. Debt markets, meanwhile, are exploding with new issuances. We will break it down in our review from the Baltic Capital Markets Conference. And in Europe, the competitiveness picture grows darker by the week. My full report from the European Business Forum is on MedianReport. We will talk. The past 10 days in the world economy have been jagged cross-current of China's acceleration, America's softening pulse, and Europe's deepening fragility. China earned rare optimism as forecasters nudged its 2025 growth outlook towards 5%. Yet October numbers cut through the cheer. Retail sales and factory output slowed to their weakest pace in over a year, and industrial profits sank 5.5%. Beijing is leaning harder into robotics, EVs, and pharma to outrun the downturn. In the US, consumer confidence slid to a 5-year low at 88.7. Retail sales barely moved at 0.2%, and the PMI dipped to 51.9. Enough to push markets into pricing an 80% chance of a December Fed rate cut. But with the key GDP data delayed by the shutdown, investors are navigating partially blind. Europe is drifting. The Eurozone PMI clings to 52.4, yet Germany, once the region's engine, remains stuck in industrial dead air. Its factories inching forward, but sentiment worsening. Britain wrestles with inflation that won't quit and growth that won't come. Layered across all of this is China's widening technological advantage, from cheap robot taxis to fast-track drug pipelines, raising alarms in Brussels about strategic hollowing out. The global picture. China pushing ahead despite fractures, the US losing steam but hoping for monetary relief, and Europe struggling to remember what momentum feels like. Estonia's late 2025 economy feels like a slow exhale, cautious but real. Average salary rose 5.9% to €2,075, cooling from last year, but still climbing, with Harju and Tartu leading and services jobs lagging far behind. Yet the recovery's pulse grows stronger. Median Harju pay now tops €1,900. Manufacturing wages are up nearly 8%, and borrowing has returned. Home loans are up 15% year on year. The average loan has reached €140,000, and monthly payments are €80 lighter thanks to falling Euribor. The developers see the bottom behind them, with Tallinn's fastest growing districts outpricing the old center and building permits doubling from last year. Energy brings both relief and unease. Dutch TTF has gas price dipped below €30 per megawatt hour, yet domestic tariffs remain steady as suppliers hedge. Construction remains subdued, but a surge in housing permits hints at the market quietly preparing for a restart. Beneath it all sits a structural fault line. Estonia's micro-entrepreneurs, 95% of all firms, operate in a country where household savings have fallen below 5% and wealth is concentrated among the top 10%. The recovery is real but fragile. Lithuania enters 2026 with rising electricity costs for most households and targeted relief for the vulnerable. Standard tariff jumps to 22 cents per kilowatt hour, while vulnerable consumers C-bills fall to 18 cents per kilowatt hour, thanks to redirected surplus revenue. Gas prices, however, ease across all groups as wholesale markets turn favorable. At the same time, a unicorn's Lithuania, an organization study, argues the country could triple its AI startup ecosystem with 2,070 million euros of state investment, generating 5 billion euros in tax revenue. Politics complicate the picture. The 3-year freeze of Lithuania's public media LRT's budget sparks concerns over media independence, while President Nausėda's proposal for a zero PIT rate for families with 2 or more children is raising alarms about fiscal populism. And with defense funding commitments soaring beyond 2028, economists warn that without new tax revenue, this next Seima will face hard choices. Lithuania stands at the crossroads, balancing rising costs, bold tech ambitions, and political strain. Latvia's 2026 story begins at home, where fewer families track their finances at all. In 2017, 55% regularly planned their budget. Today is just 45%. And the share who is tracking nothing has doubled to 14%. Meanwhile, the government itself is forced into strict discipline, cutting 844 million euros over 3 years while adding nearly 700 million euros for security, health, families, and education. Child benefits raise, healthcare expands, teachers gain a new funding model, and minimum wage inches upward. But the central bank warns of a lost decade in business lending. Latvia now has one of the lowest credit to GDP ratios in the Eurozone. Banks remain highly cautious and private investment is stagnating. The country risks drifting into a pattern where the state tightens its belt, households rely on intuition instead of planning, and companies underinvest. Financial literacy experts warn that budgeting is not a luxury, it's a survival strategy, especially when every euro matters. The Printful+Printify merger into FYUL is the Baltic tech story of the year. 2 former rivals uniting into global on-demand powerhouse. Keeping both brands, FYUL fuses Printful's production strength in with Printify's network of 85 partners aiming for faster global scale and future IPO. Riga gains a new flagship for innovation, and I sat down with FYUL's Chief People and Culture Officer, Pārsla Baško, to talk about what comes next.
Well, I think we are just starting the common journey. I probably said the same a year ago, but at this point in time, we were absolutely sure that our new strategy, our vision for the future, and the mission for the future works well with the name, which we actually had identified already quite some time ago. So FYUL is becoming our new company name, our new corporate brand, if you wish to say so. And FYUL is also becoming an engine where we are still building and continuing to develop our 3 main platforms, which is Printful, Printify, and Snowcommerce.
Yeah. What changes this brings to the current business?
I think it helps team and external stakeholders to identify ourselves with something one, which, for example, thinking of the talent acquisition in the last 12 months has been quite a challenge, because then you need to go X this or X that, and then what do you actually represent? Now, I think it's going to help us much better to align and have one statement, one offer as a corporate body in the space with, one brand.
Mm-hmm. I had a chance to talk to some people from Printify, some people from Printful, and what I noticed is that they have very strong alignment to their internal culture, to their history of the brand and everything. So how is this merger happening in terms of teams?
I think initially when we were just observing pictures from outside, they felt to be quite the same. Both companies really care about the customers. Both companies are extremely passionate about working together, building strong and good platforms. Of course, when we started working together, we saw there are quite a lot of differences, which at this point in time, I think we have been able to at least discover, and we have been also able to discuss what do we do with them. In some of the cases, we have decided to change the ways of working towards one certain solution. In many cases, we have come up with the new ways of working or new culture to be able to really address the needs both of organization as the company, but also needs of employees.
Mm-hmm. For example, as a customer, what will I see from FYUL? So what will change for me? Some maybe major points.
I think what good news is that as a customer, you will still be able to enjoy your favorite platform. They are staying, they are not going away. From the improvement side of the things, I think what you will be able to see as a customer are the fruits of common innovation. So if the platforms will start innovating or will start offering new solutions, they will be available not just in one, but in both of the platforms.
You're not planning to merge the platforms. They will stay as they are. So you
Yes.
will run them both.
Yes.
All right. Okay. Let's get back to the teams, because I see from the press release that you are proud of squeezing this whole process in 1 year, what usually would take 3 years. Are you somehow not sacrificing quality or internal trust issues?
I think a bit of everything. I don't think we had the luxury of investing 3 years in the things that we had to fix in the first year. And definitely it has taken quite a lot from the team's resources to be able to handle that speed and that process. I don't think we have sacrificed the quality. We actually invested quite a lot of time in making sure that what we offer to the organization or how we set up things in the organization is right. There was a frustration coming back from the team saying, hey, speed up, we need to have a new solution quicker. But we really wanted to make things right. So yes, a lot of speed, a lot of gray hair. I think people will look back at this year and think it's not possible, but we have got to this point in time. 1 year has passed.
All right. And how you're celebrating this moment of joining teams and everything?
You should have been in a rig office last week. You would have been seeing.
I would feel then the celebration mood. Yes.
Yes, I think we really looked back at the year that has passed. We could clearly see the wins. We also could identify what we still need to work on. So, roll up the sleeves and just keep going.
Mm. All right. And what kind of talents are you now looking for our Baltic audience? Maybe this would be an interesting question.
Hey, I'm going to do a bit of a promotion. Check out the FYUL homepage. We have all of the positions published there in our career page. But in one word, we are looking for the best. We are building one of the best organizations in the world, so we want to have the best team in place.
All right, that's a very high goal, but I think very also a decent goal. Yes, thank you, Pārsla, for your time.
Thanks, Krista.
Let me break down the story from the Baltic Capital Markets Conference into 3 parts because there was a lot to take in. First, the event itself. It was bigger than last year, packed with content, very quality content, and you could clearly feel that the overall quality keeps climbing. That's the good news. Not so good news is a feeling that I caught myself afterwards. Honestly, it was a bit like Groundhog Day, the same conversations, the same questions, the same structural problems, cycling back again and again. Which raises a fair question. Maybe we don't need this conference every single year. Maybe the Baltics can join together once in 3 years. because the Baltic markets simply don't produce enough IPOs, breakthroughs, or market action to fill a completely fresh agenda annually. So, to get a sharper, more informed view on the state of capital markets, both in Baltics and across Europe, I invited two people who truly understand the terrain. Burkhard Kuber-Sorger, who is Vice President and CFO of European Bank for Reconstruction and Development, and Uldis Tarps, who is the CEO of Finance Latvia.
There is a great political interest in further developing the Baltic markets, understanding of what needs to be done, a very European approach, and a capacity to be self-reflective over those things that have recently been implemented over the past few years, which have actually held back capital markets development, such as the second-tier pension reform in Estonia, and such as the increase of capital gains tax in Latvia. So I would say a very balanced, reasonable, and largely optimistic panel of ministers.
Yeah, first of all, I think one always needs to give credit for what has been achieved, right? And already having that pan-Baltic infrastructure is an achievement. And there's definitely a willingness to go the next step further. There might be different routes, and there might be, again, different strategies. But again, this is always what you need. You need a debate. You need to struggle and come up with the right way. And I think this is, the positive momentum, that there is a debate how to actually advance. There might be discussions what's the right way forward. But again, you need the discussion in order to actually come to consensus. And also the idea of, let's say, a unified regulator is another bold step. And I think also very strong then signal from the region to also institutional investors.
Yes, if I'm allowed to have my own reflection as well. I heard from the stage the financial literacy topic, which is, I think, reporting now for about 10, 15 years on capital markets. I think it's one of the most crucial points because what I think we as stakeholders, we are pushing politicians to make decisions, and that's our job. But I think what they are looking, politicians, they're looking at their electorate, and what they are seeing, they are not seeing this demand for such action. So basically, now they are looking at electorate, we are looking at politicians, and so we are looking at each other and trying to figure out who is going to start the boost of the capital markets. And what I'm thinking is maybe next year, in no disrespect to ministers of finance, but maybe next year we should kick off the event with economics teachers, with maybe trade union representatives, with industry association members who are pushing this information, this financial literacy.
I think it's incredibly important to continue strengthen financial literacy with all kinds of measures. When it comes to electorate's demand, I think it was very telling what Prime Minister noted this morning, that 62% of respondents actually support IPOs of state-owned companies.
But those are active investors. Those are not. Those are
no. That's not a survey of investors. It's over 1,000 people. These are not investors. So these are voters, effectively. So basically, majority of voters support IPOs. If you ask question differently, that number even increases to 72%. So in fact, there is, I would say, a broad support for deepening capital markets, and I think that's a misunderstood paradox here. When politicians talk, they sometimes say, but privatization of state-owned companies through stock exchange cannot be an aim in itself. Actually, it's wrong. It can be an aim in itself because it is a very important catalyst for everybody else. Normally, no, but in this case, yes, it is a catalyst. And the other point I wanted to make relates to people's awareness. If you look at many sociological opinion polls, and where people are asked, do you own shares? And they say, no, I don't. In fact, if you look at percentage who actually owns shares through second-tier pension funds and third-tier pension funds, we're talking about hundreds of thousands of people. So in fact, there are many people who do own shares, who are participating in capital markets, but perhaps they're not even aware of it.
They are not aware. Yeah. Your thoughts? Who should kickstart the?
Well, first of all, the point of financial literacy, right? Again, how do you measure this? And does it really become impactful if your entry barriers remain high? Let's say if I might be financially now literate, but if, let's say, capital gains tax regulation is complicated for me personally, I say, God, do I really want to go there? So simplification, lowering the entry barriers next to financial literacy is equally important. I think that is where one also needs to make an effort in simplifying this for retail investors, because at the moment, if I go to my bank and I put it into deposit, that's easy, right? If I now need to start to invest in a fund and so on, or in equity, that becomes more complicated also tax-wise. And this is, especially for lower income, something that needs to be lowered. And then I think it could work. But financial literacy in itself, yes, it's important, but it's definitely not the sole remedy to the problem.
Yeah. What about economic growth? Moderator Karl Otz mentioned it at the end of the panel that we haven't seen substantial economic growth, and he mentioned this Magnificent Seven. If we take away Magnificent Seven from the stock market, then it's not so attractive anymore. What about economic growth?
Yes, for economic growth, again, the countries need to focus on what are they strong. It's human capital. It's like innovation. This is where further investments need to be done. This is what needs to be promoted also to institutional investors. And you need private capital from, let's say, international investors that actually believe, let's say, in the human capital and, let's say, the wealth and the asset of human capital in the Baltics, and the reputation is extremely strong, and build on this asset and to attract then international investors. And it's a niche. The countries are small, and they need to more or less find, let's say, the selling point as a niche player in the international market.
I know that EBDR is holding also some shares, equity here in the Baltic countries, in the companies. Are you in some ways also encouraging these companies to issue bonds at one stage, or have an IPO or something like that? Are you proactively having this policy?
It always goes hand in hand. Let's say we have our holdings. It might be, of course, it might be loan, it might be in equity, but at the same time, it is about developing the private sector and developing also the capital market. So therefore, it is part of our DNA to talk to our clients and the projects where we invested in order to actually give them other opportunities in order to issue a bond or go towards an IPO. An IPO is from our perspective, a great tool for further mobilization of private capital. So we are not there to stay. We are maybe an anchor investor that is actually then attracting other investors. So we add credibility to a project. And we hope we have a halo effect in this regard. And therefore, when it would come to an IPO, we would say, well, that's a great success because we can more or less reduce our share and mobilize instead the private sector capital.
And it's in your DNA.
It is.
Yeah. Well, I know that I asked you this question last year, but I still will ask you this year as well. Can banks help to boost capital markets? And in what way, maybe during a year, you have seen that this has happened in Baltics?
I think they can definitely boost capital markets in several ways. One way is very direct. Banks often are owning pension fund managers. And these pension fund managers can, in many ways, through their investment decisions, facilitate capital markets. And especially now when we in Latvia have a more favorable regime for investing in alternative investment funds where you actually can charge higher management fee if you do that. That creates stimulus. Because in the Baltics, since equity markets are shallow, the best way to funnel more money into economy is through alternative investment funds and these type of venture capital and private equity investments. And we have enabling framework that it allows to channel pension money into these type of instruments. We have also recently in Latvia agreed to create a dedicated equity fund, about 100 million euros for investment in equity in companies that have high growth potential and are not only from Latvia but also from the region. That is another example. I would say a third example is all the educational initiatives banks are doing on regular basis with their customers in explaining the advantages of investment, and I think that is happening across the board. And maybe a final point is that you need to have dedicated investment banks who actually see development of capital markets not as idea but as a business. I think Signet is one such example where they have taken a business decision that they will go all in and facilitate bond issuance, and I think their market share is now very, very significant. And we need more actors like that.
We stay in Europe for the next story, this time looking at resilience and competitiveness. For that, I traveled to Brussels and I spent time at the European Business Summit, listening to both policymakers and business leaders. I went there hoping for optimism. I came back with the opposite. From the big picture perspective, Europe feels stuck. First, the current bureaucratic machinery is simply not keeping up with fast-moving markets in Asia and the Middle East. Second, over the last quarter of a century, we have built a social model full of benefits and protections that is becoming financially unsustainable, and politicians are simply terrified to admit it. And third, the Russia-Ukraine war has effectively closed the chapter on industrial Germany as the economic engine of Europe. That era is over, and we need to admit it. At the conference, people pointed to the Nordics, Poland, and even the Baltics. The question is, are we ready to take the lead? The forum also highlighted new partnerships, especially with Turkey and Europe's emerging frontier countries. Moldova took center stage with its deputy prime minister promoting the country's rapid digital transformation and signaling their readiness to join the EU, even in these difficult times.
We do listen to our friends and to our partners. We do listen and we do not make mistakes, since the lessons learned are being shared with us. And this is indeed a transparent work that we're doing, including with Latvia, by the way. And using it, since we look into the industrial possibilities of Moldova and some of the competitiveness advantages that we have. So, newest technology, and this is a bit cynical, but we have to understand that this is because of the war and the hybrid war against Moldova, that we're using all of these technologies, we're implementing technologies, we're advancing with AI. So I think that all of the countries can cooperate close, especially our eastern countries, and to make that firewall protecting the eastern flank of the European Union. In terms of technology, it's also the advantage of parks that we have established, where we have the R&D, as I was saying, that we have a couple of R&Ds, but also the sandbox framework, where we do want to allow entrepreneurs to make mistakes, but not to be punished. So they want to invent, they want to test, and then to implement. So that's sandbox framework, as we're saying.
And there's the irony. The very bloc Moldova hopes to join itself is drifting apart, not politically, but economically. Different speeds, different levels of ambition. Southern Europe, led by the Iberian Peninsula, is pushing harder to show what a truly integrated single market could look like. The Baltic Capital Markets Conference also touched on this again this year, and the message was clear. Fragmentation doesn't help anyone, especially in times of IPO draw. Weak sentiment, shrinking liquidity, and the market waiting for macro clarity. This is the environment issuers face. So, what will it take to revive capital markets in the Baltics and across the EU? I put this question to two experts at the heart of equity markets.
You can say, is it because that we are fragmented? Actually, a lot of things happen is more on the bigger picture. The fact that the interest rate in 2020-21 was super low. So that was a lot of the company that wanted to go to the market went during that time. So of course, then there is much less now. On the other side, at that time, we didn't see the drought, definitely. I think the drought is more driven generally by the economic development of individual countries. The fragmentation itself is only feasible when we are already going into the details. Should I list here or should I list there? Or should I do both of them, like the dual listing? I think we could overcome the fragmentation together as what Nasdaq Baltic or the Nasdaq Nordic has done. But this is not the reason of the drought, in my opinion.
But still, it's a capital flow. It's a larger scale. Investors from Portugal can look at the Baltic markets and they suddenly see it somehow, and the capital is flowing. Isn't that also isn't that the case?
I think, yeah, the infrastructure and the CSDs are fragmented in Europe. I understand that they are more and more working of getting it flow easily. It has been in history that it has been challenging to get kind of the physical, almost like shares moved across Baltics to Germany or anywhere. But I understand it's getting better. The CSDs are really working on it. And for example, Germany was a bad example because if you list in Baltics main list, you can so easily have a secondary in Frankfurt. Mm-hmm. It flows so seamlessly. But yeah, I've heard, and it's good to hear that they are seriously working on it.
The progress is there.
Yeah.
Okay. I have a second hypothesis as well. It's from me. So just because we don't have also, let's call it, if we compare to United States, a decent technology industry in Europe that can compete globally, is there a reason why we don't see also many IPOs? Because, of course, now currently tech industry is very active on market.
So for the tech companies, what we have seen is that when they are starting to have a very, very good proof of concept, a lot of funding is still done privately, so either by the private equity and the private debt. And then the source where these investors are also drive where the IPO is taking place. A company that is mainly financed by, let's say, European private equity, then most likely the IPO can take place here. But if it is financed mostly by US, they also learn how it is, the capital market working in their home country. It's a given that the risk-taking appetite of the Americans are just much higher than here. And we were consistently told the market is deeper there, so the valuation is therefore higher. And when you are presenting a future-oriented growth and so on that is far distant future, it's a lot more likely that they actually understand it or accept it than here. It's the moment it's like that. It takes time to adjust it, but unfortunately it is like that. Nevertheless, US is not for everyone. You cannot be a small fish in a big pond. Yeah, so there is a certain deal size, minimum market cap, so that you are feasible. If you are a small tech company in Europe, the best is to be listed in Europe.
Yeah, I think like the home market validation is so essential, that where your roots are, where you come from, like the support you get from this really home investors that Every time we do roadshows, every time internationals ask what do they think back home. Like if you can't answer it with really sincere that there's very good support for it, then they move on to the next. So it's essential that the home market can reach, and it's best reached, especially for retail, if it's listed in your home market as well.
But then again, I have heard in different conferences the same Vinted or Bolt or Printful, now FYUL, that European markets now currently are probably too small for them. They are looking to New York.
You mean for listing?
Yeah.
Well, I mean, we have to work on that. Yeah. So I wish Adam is here to explain from his side as a Nasdaq Stockholm head. Yeah. Bolt is a very European brand. Yeah. Everybody use Bolt. Yeah. Even in
Also Asian markets as well.
Yes.
Very rapidly.
And to be listed in the US, you normally have to have a presence there. Where is the awareness of this particular company there? So it is indeed, if it is from the investor pool point of view or the one who's financing, it gets more and more towards that direction. But at least we should really give our best to convince the sellers that there is investor demand also in Europe for such company, because this is their home market or their ex-home market when they were smaller size.
Yeah, I think it's exactly like what Adam showed with this, was it Verisure or this big IPO that they had, that a lot of investors were like pure, almost Swedish originated. And, you can go wild and think that you're so great company that, you will anyways make it in US. But then again, like in challenging times, that you would have the local investors backing you up. You will definitely have a good IPO, good aftermarket trading. That's what you want to take, because IPOs are always a risk. And at the time of, going out and book building, it's always like the day before, it's always so nerve-wracking how it will go. So at that moment, you will be thinking back that, okay, I don't know yet, but when you're closer to home, it will go well.
It is time to act. That was the message repeated again and again at both the Baltic Capital Markets Conference and the European Business Summit. The initiatives are there. The Scale Up Europe Fund, EU INC, the Savings and Investment Union. We're also seeing powerful collaborations like ISML working with Mistral, Rheinmetall connecting with Interatech. Real momentum across sectors. The energy is there, the ambition is there, but the results aren't arriving as fast as Europe needs. On stage, one voice cut through the noise with striking clarity. Anne Mettler, Distinguished Visiting Fellow at Columbia University's Center of Global Energy Policy and one of Europe's most influential strategic thinkers. Her message was firm, urgent, unmistakable. Here are some key moments from the panel, and then I have a short conversation with her afterwards.
I don't speak on behalf of business, but I don't think that business has a sense that there's a lack of urgency. Any company that is competing in the global economy feels a lot of pressure and feels a lot of sense of urgency. I just moderated the dinner with CEOs just a few days ago, and one of them said, I really don't know how much worse does it have to get before there's really sort of a major change, a palpable change of what is happening here. So I think the business community cannot be blamed for this lack of urgency. But coming back to the original question and what you're describing as the competitive advantage or the lack of competitive advantage that Europe now has in global markets, it's very important to understand that for a long time, no one really thought here in Brussels about what can we do that others cannot do. And of course, we haven't been able to compete on price for a very long time. So this was a really important question. If we cannot compete on price, then what are we competing on? And who? in their right mind can think that we can sustain this social system if we can no longer do things better than others in the world? So I think the sense of urgency for some people has been there for a very long time, and I can assure you, and you know this, that for me, I've been working on these issues for 20 years, and it's only now that we are waking up. So I say, as a matter of urgency, first of all, we need to understand where do we still have a competitive advantage, and we certainly do in certain areas. ASML, also Zeiss, Trumpf, those are world-leading companies that can do things that others can't do. We need to keep a laser eye on them, that they remain European and that we protect them, that we really make sure that they are on our radar screen. Then we need to build up new competitive advantage. I go around Europe all the time. We have amazing startups, amazing companies, big and small. It's about time that we somehow unleash them, that they can move again, that they can do things, right? We try to micromanage something here from Brussels that we don't even understand. So what I'm saying is, in many ways, in my opinion, this system, we're fiddling around a little bit here and there, but the operating system of Europe is broken. The operating system. And the discussion we need to have is not a little bit here and there and another act and another compass and this and that, but really how do we reboot? How do we do policy planning in another way? And here, this report, 25 years, is really an eye-opener, because if you look at the last 25 years, all I have to conclude is we haven't done a good job.
Well, the first thing to understand is that business cannot be viewed with general suspicion. Business is what sustains our social welfare, and what one can say with certainty is that European companies operate more ethically and more sustainably than the vast majority of their international counterparts. So it's very important to understand that those very companies that have worked more ethically, more sustainably, we have put under enormous pressure with a lot of regulations, with a lot of micromanagement of their operations, while at the same time keeping markets wide open for their international competitors that are not subject to the same regulations and that do not operate as ethically and as sustainably as our European companies have. So thereby, we have actually achieved the very opposite of what we set out to do. We have weakened our own industrial base, and we have made others strong that, as I said, do not operate under the same sustainable and ethical guidelines as our own companies. So it hasn't been good policy. Well, I think we need principles for policy making, and one principle needs to be that we do not treat our own companies worse than their international competitors. This would be a very good starting point. We cannot regulate these companies simply because they are in our regulatory remit and then keep markets wide open for their competitors who are not subject to these same regulations. It is important to understand that regulation per se is not bad, but more regulation doesn't mean you get better outcomes. And every regulation, even a good one, means a cost. It's a compliance cost. So the more regulations we put on our companies, the higher the cost, the less competitive they will be. So in a way, through our own policies, we make others big and keep our own companies small and marginal. For the rest of, let's say, especially in the policy domain, there is not the necessary sense of urgency. And I think this is something that clearly came across this morning in the opening panel.
And let me end with something positive, because despite all the frustration we've had and we talked about, the Baltic region delivered one bright, undeniable success this year: the bond market. Debt capital markets in the Baltics have exploded in 2025, breaking every previous record. Companies, big and small, seized the moment and tapped into a surge of demand from both institutional and retail investors. Finally, a market that works, attracts capital, and provides real financing alternatives. To wrap it up, I sat down with two people who see this shift from the inside every day.
I think the key takeaway is that good that we compare ourselves, and by mean the Baltic market, so we compare ourselves to the Nordic bond market. which is by far the most active in the European Union, this year. And what the key takeaway is that we need to copy paste from them is the unification in terms of for the Baltic states, we have to be a one market. Obviously, we will not be a one market, but at least from the investor's perspective, the investors shouldn't think is that the Latvian or the Lithuanian company is the Baltic company, and the documentation when it comes to the bond documentation should be similar across the Baltic states, and that when it comes to documentation, the bond documentation, the trustee as a middleman between the investors and the issuers, because that's a concept that's only embedded in law only in Lithuania, but still not yet in Latvia and Estonia. So that's something to work on, and yeah, just to act as a joint force, as a joint market, in order to unify and to attract the foreign investors.
Okay, your thoughts, Rikimatas?
Yeah, so it seems that Baltic market getting more active in fixed income instruments, and I'm happy to see that trend. Let's hope it will continue and do like Nordic. Of course, size is much different, but direction is at a good way.
When I see, as a Latvian, see something live and kicking, I always think of the risks, and I see that the bond market is like wakening up and everything seems very nice and fine. Do we see some kind of like underground, like underwater rocks where we still should be cautious a little bit to overcome them? Whoever wants to answer.
Yeah, I would say that it's still a credit. It's still a risky product in a way. There's no free lunch. There's no risk-free investments at all. Therefore, whenever you see a high-yield bond offering, double-digit return, obviously there's a risk embedded in there, and you have to sleep with that. You have to understand that. Whether we see some bad apples in the market, yes, and that's already quite visible for the last 2-3 years. There are some restructuring, some bankruptcies in the market. Whether that stopped the development of the market or the trend of the market, not really. Maybe those cases were more isolated. Maybe those cases were not that public, and that didn't affect the public or the retail investors that much. So it's not to say that we don't have anything already, some bad apples popping up. And whenever there will be one case that will destroy the market, there are these cases already, and it's not, we're still on a track, on a growth path, going forward.
Maybe not repeating regarding credit risk, because it's always attached to investments. Maybe what I've seen, me personally, what with double-digit or high 9-8% attract investors in recent years, and nowadays the companies are able to refinance at lower rate and still attracting the same investors or new investors as well. So it seems what market get to that point, what there is investors base who are active in that market, and even Euribor decrease in recent years by 2%. Still, there is still interest in fixed income instruments, bonds as well.
I see that in all 3 Baltic countries, retail investors have waken up and are more and more into the bond market as well. But how we can even more maybe amplify the presence of retail investors here? Or is it also important? Or
definitely, retail investors are important in every product. Even the banks who are actually losing the money from cash accounts because it's employed from cash accounts to some instrument. We are also for this movement, because when the society gets richer, we earn coupons, interest as well. It's better for the banks as well. So it's like a side effect for that. What it might be better way, so it's definitely access to these instruments for the cheaper price. If it's like couple of basis points, no, not couple of 10, 20 basis points, which is, compared with 8% yield, is not much, and you can get that bond in your investment account. It will be easy to attract with retail clients.
I think this retail part is somewhat of a unique Baltic product, because when you look at the US market, UK market, or even the Nordic market, when it comes to the primary issue, there's no retail. Usually, there's no retail investors in there. And
Is it because of the maturity of the market, or there are some other reasons?
I think it's this uniqueness of the Baltic market is connected to the Nasdaq systems, and I think if the Nordics would have the same Nasdaq auction system that we are having here in the Baltics, which effectively connects all the banks, all the depository and the depository members here in the Baltics. Therefore, you're not, because how it happens in London and in New York, you as an investor, you go to the investment bank arranging this particular deal. There could be one, there could be many, but still you need an access to that arranger. And in the Nordics is the same. For us, when you do this public offer, everybody can log in your internet bank, whether you're a client of any retail bank. You can, sometimes it's easier, sometimes it's harder. Maybe you need to call somebody in the internet bank. But regardless, there is a way on how you can, as a client of any retail bank, to subscribe to any public offer out there, both for bonds, both for stocks, and it's somewhat of a unique tool that we have for us as a smaller market that connects everything, and it allows everybody to be connected and to can participate. Therefore, I think that is maybe sometimes portrayed as a risky thing, that you allow the retailers to participate in those issues. But usually the retailers are the ones participating only on the secondary market, and the risk is still there even if you buy it on a secondary. So we actually, with this auction system, we allow the retail investors, private individuals, to participate almost at the same level like institutional investors, which is fantastic in terms of the accessibility.
Yeah, exactly. That helps. I assume that among audience there are many investors who are familiar with stocks and ETFs and so on, but maybe not so much with debt capital instruments and so. What would be your, let's say, ABC first steps into this investment form? What would you suggest for a new investor? Maybe also to encourage them not to be afraid of that. So yeah, whoever wants to start.
I think at least who already interested in that product, so we managed to go through that process successfully, and taking in the main risk is credit risk regarding the company as itself. So even you are looking at a product as itself, bond, called as like safer product, but understand behind that what is a risk. And we had in Baltic some with bad apples, which is already in places, and probably it's already learned by this retail clients. For the new ones, so probably it's who are very cautious. They need to start with lower risk products. It might be government, it might defense bonds, so on, or high rated government-owned companies as well, which is in some cases they pay more than deposit rate. So the starting point, it might be with a lower rated, lower risk with lower coupon interest as well. But the starting point, it might be good switching from deposit to definitely higher risk versus deposit, but still highly rated bonds as, for example, government-owned companies.
Great advice.
Yeah, I can only echo what Regimantas was saying, that if you are a Latvian and you want to try this fixed income, try the krājuma obligācijas, right? If you're Lithuanian, try the taupījuma lakštai, right? It's a state savings bond as an alternative to just your money sitting in a deposit or just in a regular account. It don't need to be thousands of euros. You can use that. I think it's 100 euros minimum. So it's a very democratic way on how to just feel how the fixed income instruments work, and maybe not go directly to the double digit whatever is on the offering plate right now. maybe, step by step, start from the lower risk and then gradually go up.
And that's it for today's episode. I'll see you in 2 weeks when Lithuania takes center stage. We will dive deep into the country's economic momentum, what drives it, what threatens it, and how Lithuania can keep its lead in the region. Thank you for watching. My name is Chris Peterson. This is MedianReport, and we will talk.